probably the best thing we need is to, get the BIS and all the bullion banks out of the game. I mean, it's so heavily manipulated, but yes, I mean, it's a matter of a number of things. I mean, I think people need to, there was a survey that said it's out of date now, but it was 4 months ago. It said that 70% of the people think that inflation is transitory. Well, I think that's going to dissolve. I mean, I think people are going to, finally, with all these supply chain things and, transitory is a few months, we're going to be into years and years of deflation here, and it could arguably be getting worse throughout that period. So as transitory dissolves into permanent inflation, that's going to really change investor sentiment a lot. And people are going to say to themselves, oh my, I've got to protect myself against the debasement of my purchasing power. And so, some will go to stocks, and stocks represent somewhat of protection because they are an enterprise that can reprice and so forth. But a lot of them will also go to, the thing they'll get out of, the worst asset obviously will be bonds. So they get out of bonds, and that might force the Fed into yield curve control, but then they'll run into, hard assets. And actually, you're kind of seeing that in the housing. I mean, I think it's fascinating that U.S. housing prices are up 23%. It's not because we have a shortage of housing. That was bigger than the housing bubble. And year-on-year growth at 20%. Well, I know what that is. That's just housing guys doing the Hugo Stinnes trade, where they're, a house is something. It's something you can use. Two, it's something that theoretically protects against inflation. I mean, it does have taxes and it depreciates over time, but in general, a house is a real thing. It's not a bond. And and three, you can buy it cheap. I mean, the government will give you 30-year money at 3%. So if inflation is really running at 7 or 8%, so the value of your house is going to go up. Well, this year housing prices inflation went up 23%, right? Mm-hmm. And you can borrow money at 3 to do that for a 30-year window. That's like a no-brainer. Mm-hmm. That's just a complete no-brainer. So you're seeing it there, and it's a combination of factors, Tom. I mean, I think it's just a matter of time and investor psychology changing. And to me, this period in the gold price reminds me a lot of the period around 2008, where 2007 or 8, it kind of hit the old high of $800, which was the old high from 1979, 80. And we had the old high from 2011 was 1900. We hit that and beat it slightly last summer, went to 2050. Came back underneath it, went down in the 16s. Now we're back in 1750-ish range. And, we're fighting to get through that 1900 permanently, and then 2000. And once we do that, it's going to take off like a scalded dog. I mean, it's just going to be, the inflation trade is going to be on, and it's going to be something to behold. So it's going to feel like last summer felt. Mm-hmm. But, we're not quite there yet. I mean, there's still a lot of people, haven't figured out where inflation is. And there's, there are people saying deflation will return, and it's been a deflationary world and so forth. So I think it's going to take, a little bit more of beating investors over the head. And it's very common for people to invest in the rearview mirror. I mean, look, the deflation trade has worked for 40 years, since 1980. But you're seeing, and it's so funny, you're seeing all these mirror images of things changing in 1980. I mean, I remember 1981, Reagan broke PATCO, which was the air traffic controllers union, basically fired them all and hired new guys. And, that was the beginning of the downturn of unions and union pricing power and the power of labor and everything else. And, just recently I read that John Deere, the entire company went out, and they're not going back until they get better living wages. The whole country's watching them. Mm-hmm. And, so you're going to see a trend. I mean, this 40 years of deflation benefited, Wall Street versus Main Street. And I think that's changing. I think Main Street's so angry, and by the way, there are job shortages, so that, Wall Street and these companies are going to have to pay people more. They just have to. And, higher inflation is going to cost them more to live. They're going to demand higher wages. I mean, that's the thing. When you get into an inflationary environment, it's a cyclical thing. It's a cycle, and it has a psychological point to it. I mean, you buy things that you may not even need because they'll be more expensive in the future, which increases demand for those things, which then increases price for those things, which then increases inflation, right? So it's like it's a terrible vicious circle, and it can happen. And I saw it happen. I mean, in the 70s, I remember my parents would buy a used car or a new car and could sell it used or trade it in used and get more credit for it than what they paid to buy it. Of course, the new car they were buying cost even more. But the point is, since when have used cars actually gone up to values over and above their sticker price? I mean, that only happens in a highly inflationary environment. You're seeing it now.
Larry, you mentioned the energy input cost of Bitcoin and of gold. And with oil nearing multi-year highs here, is this going to continue to exacerbate the raw costs of everything to keep?
I think climbing? It is, and I think it's interesting that you mentioned energy, because I'm more and more as I read and study, I'm coming to believe that money really is just energy. I mean, everything that's energy related is measured in money, and everything that's money is kind of measured in energy. And so, arguably even oil could be a good form of money. I mean, it has its issues, but the point is that, gold is the stored energy that it takes to mine it. Bitcoin is the energy it takes to keep the network running. Oil is the energy that runs the world. And, one thing I will point out, though, I know one of the knocks on Bitcoin is that it absorbs way too much energy. And I think that's a false criticism, because I've seen studies. Nick Carter's done some great work on this that show that Bitcoin consumes about 0.4, maybe 0.5% of global electricity. And so, you ask yourself, well, is it worth it to have a sound form of money? Is it worth 0.5% of electrical costs worldwide to have a sound form of money? I would say the answer is yes. And you and I were talking beforehand. I have not done the math, but I will do it. I'll bet we spend more than that mining gold today, more than 0.5%. And I know we were talking about this as well. I know the U.S. military consumes 1% of the oil consumed every year, every day, worldwide, and I'm pretty sure that's more than 0.5% of the energy in the world. So the point is that, anything that's money, having a sound form of money, is going to consume energy. Banks consume energy. Every business consumes some energy. The issue is that energy being used well? And I think in the case of Bitcoin, as in the case with gold, it is being used well because it's creating sound money. The energy that's not being used well are the 20,000 people that work for the Federal Reserve. I don't know how they need 20,000 people. They need one guy to push the print button. That's it. That ought to do it.